You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from The Moose on the Loose. I hope you're doing well today. Happy Monday. Today, we are making the Tonka battle with Finning International versus Toromont Industries. So you do have one in your portfolio, both in your portfolio, none in your portfolio. This is what we're going to talk about. So Finning International, FTT, Toromont Industries, TIH. When I compare two companies in the same industry, what I do is I use a 6-step methodology that I've developed at DSR, and I actually have a complete newsletter for my Dividend Stocks Rock members so they can download it, read it, and understand how to compare companies easily using, of course, our stock comparison at DSR as well. So the 6 steps is we're going to look at the business model, trying to explain it to a 12-year-old so we know that we understand it. We're going to look at the dividend triangle. We're going to identify growth factors, also identify potential risk. We're going to compare the dividend safety and expected dividend growth. And we're going to conclude with the valuation, which, you know, it's not my favorite part because my guesses are as good as yours. And there are like multiple ways to just end up with a calculation. But anyways, it's still interesting to compare two companies. So first things first, what's Finning International? Well, it's the largest Caterpillar dealership. So they sell, rent, and provide parts and services for those equipment. So think about big Tonkas, that's going to make it. They are present not only in Canada, actually it's in Western Canada. It's important to make the distinction because then we're going to switch over to TIH. But they're also present in Chile, Argentina, Bolivia, UK, and Ireland. So they're well diversified and they serve the mining, the construction, energy sector, forestry, and wide range of power system applications. For TIH, Toromont, well, we have a company that is divided in two segments. So the first one is equipment, which is very similar, same thing, a Caterpillar dealership. They also run the brand Ewit, and they are present in the rest of the Canada outside Western Canada. So they have like big provinces like Ontario and Quebec, but also the Maritime. So they take everything outside of the Western. The Western is reserved for FTT. They are also serving many industries such as like road building, mining, telecoms, food and beverages processing. What's interesting is they also have about another 10% of their business that is in Simco. And Simco is doing everything that is related to industrial and recreational refrigeration system. So they design, they engineer, they fabricate, they install, they take care of it. It's all about this. And so very, very similar business model, especially if we're thinking about Simco that is only 10% of TIH. That's pretty much the only element of differentiation at this stage. For the dividend triangle, step number 2, so I look at the revenue growth, earnings growth, and dividend growth over the past 5 years. For the numbers, actually, it's kind of ironic, but Finning is beating TIH over the revenue and the earnings. So for revenue, we have like 8.5 versus 5.7. We have 20.7 versus 16, so double digit for both, but still Finning shows higher earnings growth. However, for the dividend payment, Toromont is a double-digit dividend grower at 13% annualized growth rate for the past 5 years, while Finning is at 4.5. So depending on what you're looking for, and I would say that TIH, when you look at the trend, is a little bit more stable than FTT over the past few years. So the trends looks stronger, even if the numbers are a bit weaker for Toromont. Now, growth factors. Well, in general, since they have a similar business model and they are doing pretty much the same thing, it is definitely a play on the infrastructure spending. So we know that governments are looking to spend a lot more in infrastructure, in mining, and that will benefit for both companies. The main difference, I would say, is FTT will benefit from a more diversified territory. So if there's anything going on in South America, they will be there and they will benefit from it, while TIH is kind of stuck in a sense in Canada outside of the western part. So this is more like a downside than anything else. So for TIH, they could make small acquisitions such as EWID that they did. And I like Simco because it's not only a business diversification, but it's also a growth vector for them. So that could lead the way. But in terms of growth factors, there's not much of a difference here either. Now, for potential risks, well, it is quite similar once again. I mean, both companies are quite cyclical. It's important to understand that the sale of new equipment is only going to work when you have like massive spending. If we have like a rough economic situation or a recession, a lot of companies will focus on repair and maintain their fleet of equipment instead of going for new ones, right? You don't want to buy this new Tonka like at that like $300,000 if you can just run the old one and it's going to be fine. So of course the backlogs, you're going to see it. It's going to slow down whenever the economy it's a roadblock, and both companies will face the same problem. Now, Finning is twice the size in terms of cell than Toromont, so it is a little bit more protected. So TIH is a little bit smaller. It's only focused in Canada, so definitely that could be a threat going forward, because if this small territory is not performing, well, they're not going to benefit from anything else, as opposed to FTT that is present in Western Canada, but also in UK and also in South America. On the other side, South America, like for those who have shares of Scotiabank, they know it's sometimes very good, sometimes not that good, because it's a little bit more volatile on the politic front. So a bit harder to predict what's going to happen, but those are like the major potential risk here. Compare number 5, compare the dividend safety and expected dividend growth. Well, both companies are very solid dividend payers. Toromont offers a yield of 1.5. Finning International is close to 3, so 2.78 right now. So if you're looking for income, you're going to be more tempted by the largest player with the largest dividend yield. In terms of payout ratio, we're talking about payout ratio under 30% for both. For the cash payout ratio, it's about 50 to 40%. So very, very solid. Plenty of room to grow their dividend. However, Toromont Industries definitely has the longest dividend growth streak with more than 30 years, double digit over the past 5 years, but 1, 3, and 5 years shows double digit dividend increase. So if you're a little bit more geared toward dividend growth, well, then you're going to pick up on Toromont. And ironically, when you look at both, there's only one of the two that is part of the Rockstar list at the moment, and it is Toromont Industries. So the Rockstar list, it's a free list that you can download at moosemarkets.com/rockstars. The list will pick all the stocks that has a positive dividend triangle and a Chowder score about over 8. And for Finning International, the Chowder score was only of 7 as of late, because they didn't increase their dividend during the pandemic while Toromont continued, so that affected their 5-year dividend growth rate. So that's why we're at like 4.5. So the Chowder score is too weak to be considered in the Rockstar. Doesn't mean it's a bad stock though, but I just want to highlight it. So once again, if you want to download the full list covering all the companies that are thriving right now that have strong fundamentals, you're going to find it at moosemarkets.com/rockstars. And to conclude, and I know in 10 minutes it's very fast, you need more time to go and do a deeper dive, but I just wanted to give you an overview and how you can actually apply that 6-step rapidly. So one thing that I like to do with the valuation is to focus on the P ratio versus the average 5-year, and the same thing for the yield. So for Toromont, we we trade about 20 times the earnings, and the average PE ratio of the past 5 years at 23 times. So the PE ratio at 23. So there's definitely some kind of like an interesting deal here to invest. And we see the same thing for Finning International. So the forward PE ratio is about 10, the current PE ratio is about 11, and the average over the past 5 years is at 14. So once again, we might have an interesting play here on both sides. So depending if you want to have the largest player in terms of revenue, more diversified, offering a higher yield, Finning International is probably your go-to stock. And if you're looking to add more growth, especially in terms of dividend increases, a longer streak here, and go focus on the low yield, high growth type of stock, Toromont would be a pretty good fit. Long story short, right now, both companies have similar business models, similar opportunities, and similar threats, and I really like both of them. I have just a preference for Toromont. Full disclaimer, this is the one that is in my portfolio. The reason is simple. It is the strongest dividend grower, and in between two companies, I always go for the strongest dividend grower. I mean, that's a bias, of course, but that's mine, and I'm happy with it, and that's it. So, all right, Moose, I kept you long enough today, so hit me on YouTube. Tell me which one is your favorite, Finning International or Toromont Industries, and we're going to have the discussion over there. Until tomorrow, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.